Live. We're here to cut through all the noise and get you straight to what really matters. Today, we're plunging into the Canadian real estate market. It's pretty complex right now, very dynamic. We're looking at June 2025 trends specifically. Our goal here is to give you that shortcut, help you get informed quickly. We've dug into sources like the Real Estate Magazine YouTube channel, OMAXE Real Estate Content, and we're pulling out the key facts, the surprising bits, trying to help you navigate all the different stories out there and understand the why behind these shifts.
Exactly. And what's particularly noteworthy, I think, is how much of what we're seeing today really echoes past cycles. But, with unique twists, things shaped by current global events and also these really significant population shifts happening within Canada.
Okay, let's dig into that. Those global and national headwinds, starting with trade wars, maybe. Canada's got this record low goods deficit with the U.S. right now. Sounds like it's mostly because exports have just collapsed. Iron, steel, lumber, cars.
Yeah, aluminum too. It's all down to the tariffs pretty much. And we saw this weird thing happen before they kicked in front loading, they call it.
Front loading?
Yeah, like businesses rushed to get stuff across the border before the tariffs hit. So demand was pulled forward. It made things look, are artificially good for a bit, boosted activity temporarily.
Ah, okay.
But that's obviously subsided now, and it's left us with what the sources are calling a really bad economic setup.
Right. And I guess some places are feeling that more than others.
Definitely. You look at cities like St. John with oil refining, or Calgary, obviously oil, Windsor with the auto sector, Hamilton steel. They're all pretty negatively impacted, but then you contrast that with somewhere like Sudbury. It seems less affected, maybe because its economy is more diverse, minerals, the Ring of Fire connection.
Interesting contrast. Okay, so that brings us to geopolitical stuff. Oil prices. The situation in the Middle East, that must be having an effect.
Well, yeah. There are big fears about the Strait of Hormuz closing. That spiked prices for a while. They've fallen back a bit since then, but they're still definitely elevated compared to before these recent conflicts started.
So could that actually help Canada? Like higher oil prices boosting Canadian oil? Maybe offsetting those tariff impacts we talked about, especially for, say, Alberta?
It certainly could. It's potentially bullish for Canadian oil, yeah. It provides a bit of a counterweight.
A counterweight, okay. But are there, other global factors maybe limiting that, or is it pretty straightforward?
Oh, it's never straightforward, right? There are always broader global supply and demand things going on. But yeah, from a purely Canadian perspective, especially for the energy sector, higher prices are generally a positive pressure against those other headwinds.
Got it. Okay, so shifting gears a bit. Unemployment trends. What are we seeing there?
Well, nationally, the rate's up 40 basis points. That's 0.4%. But the interesting thing is the regional difference. Ontario's up 60 basis points. Alberta's up 70.
Wow, quite a jump.
Yeah. But then you look at Saskatchewan and New Brunswick, and they've actually seen decreases.
And Ontario's struggling. That has bigger ripple effects, right? Given its size and connection to the auto industry, those tariffs again.
Exactly. Ontario's position means its struggles can really drag on the rest of the country. And there's another slightly worrying point here. There seems to be a pretty big gap between the Bank of Canada's own survey data, the labor force survey, and the official employment data. It suggests job growth might be quite a bit slower than the bank thinks.
Slower? How much slower?
The gap is apparently comparable to what we saw during the COVID period, which is significant.
Okay, so what if the Bank of Canada is working with a potentially, let's say, optimistic view of job growth? What does that mean?
Well, it ties into their view on inflation, too. They seem to be attributing a lot of current inflation to mortgage interest and rent costs.
Right, which have been high.
They have, but we're actually seeing rents fall in many markets now. So if the bank is focused on those factors, it might mean that once those components normalize, headline inflation could look quite a bit lower, maybe faster than they anticipate.
And if they're also underestimating unemployment.
Right. They might be slower to cut interest rates than the actual economic weakness might warrant. It's a potential blind spot.
Okay. And are we seeing specific industries shedding jobs beyond just the overall numbers?
Yeah, definitely. The sources point to agriculture, retail, construction.
Construction, why is that?
Mostly project completions, apparently, and also low pre-sales for new projects. So less new activity starting up. Also accommodation, food services, manufacturing. They're seeing declines too.
But there's a twist, right? Some sectors are actually adding jobs.
Yes, and this is really interesting. Real estate, finance, insurance, rental, and leasing. Those sectors are growing.
Huh. Why would real estate be adding jobs when the market's been, well, slow?
It's a bit counterintuitive, but think about when the real estate industry felt the pain. It really started with the rate hikes back in March 2022. A lot of professionals saw big income drops then. So the industry arguably entered its recession earlier than other sectors,
Okay.
which means it might be poised to recover sooner now as rates maybe start to slowly come down and transaction activity picks up, even gradually. Real estate might actually lead the recovery somewhat. Instead of lagging behind, it changes the investment perspective a bit.
Okay, that makes sense. And connecting this to mortgages, fixed rates are tied to bond yields, right?
Directly. Bond yields are high, so fixed rates are high. Banks usually add, 100 to 200 basis points on top of Government of Canada bond yields.
But what are people actually doing? What are consumers choosing?
We're seeing a shift. More people are opting for variable rates or maybe shorter fixed terms, like 3 years.
So they expect rates to fall.
That's the signal, yeah. They're betting that within the next 3 years, rates will be lower than they are today.
But the U.S. Federal Reserve, the Fed, they play a huge role, don't they?
Absolutely critical. And the U.S. economy has been surprisingly resilient. The Fed just doesn't seem to be in any rush to cut rates, despite what people expected maybe 6 months ago.
Which makes it tricky for the Bank of Canada.
Very tricky. Although, interestingly, the Canadian dollar has held up reasonably well, partly because the U.S. dollar hasn't been super strong either.
So that gives the Bank of Canada a bit more wiggle room.
A bit, yeah. More room to potentially diverge from the Fed if they wanted to without causing a massive currency depreciation, even if they seem hesitant to react quickly to the negative Canadian data we're seeing.
Right, and all this, the higher rates, the uncertainty, it's affecting the mortgage market itself.
For sure. Growth in the Canadian mortgage market is pretty low right now. Most of the action is just renewals, not a lot of new mortgages being written, which impacts the banks.
Okay, so we've got trade issues, oil prices, jobs, rates. And this is all feeding into something else pretty major. Population shifts. Canada's population growth has fallen for 4 months straight. That sounds significant.
It is, and some provinces might even be seeing net outflows now. Potentially Canada overall, winter population growth was the lowest in recent memory.
And this includes non-permanent residents,
Yeah.
right? NPRs.
Yes, a noticeable decrease there. Some are transitioning to permanent status, which is one factor, but others are actually choosing to leave Canada. Maybe the economic prospects here aren't what they hoped for.
That sounds familiar. Didn't something like this happen before?
It really echoes the 1990s. Back then, we saw a big outflow of non-permanent residents, not because of policy changes, but just by choice. The economy was poor, and it mirrors what we're seeing now, especially if you look at things like rental price trends.
Interesting. And the government's recent announcements? Capping foreign students? NPRs?
Well, it's kind of intriguing, right? It looks a bit like they're front-running these economic trends that were already happening, like taking credit for organic shifts already underway because of the economy.
And people aren't just leaving Canada, they're moving within Canada too.
Big time. Interprovincial migration is really reshaping things. Ontario and BC are seeing net losses. People are leaving.
Where are they going?
Primarily Alberta. It's being called the fastest growing sub-sovereign state on Earth.
Wow.
Yeah, and Calgary is the fastest growing city, 11% population growth.
Yeah.
That's directly fueling the strength we see in Alberta's housing market. It's simple demand.
So it's like a return to older patterns.
Exactly like that. Historically, cities like Toronto were often transitory hubs. People, maybe immigrants, would land there, stay a year or two, realize it's just too expensive to really build a life, and then move out to more affordable places where they could actually buy a home on their salary. We're seeing that pattern again.
And there's this other weird trend. More people per house.
Yeah, it's counterintuitive, but the number of people per dwelling is actually increasing. Square footage per person is going down.
People are consolidating households. Doubling up.
Precisely. It's a direct response to unaffordability. An invisible supply factor, you could say.
So what does that mean for building targets? Like CMHC wanting 400,000 units built a year.
Well, it raises a big question, doesn't it? If population growth keeps falling and people are consolidating households more, maybe we don't need that many new units. The source suggested building even 300,000 units, if population growth stalls, could make the market completely unrecognizable, maybe oversupplied.
Okay, wow. So let's transition then to supply, affordability, regional differences, starting with the rental market. GTA specifically.
Right. The Greater Toronto Area rental market is seeing record high weekly new listings just about every week this year.
Record highs.
Yeah, often up 30% compared to usual. And that's putting serious downward pressure on rents. We're seeing double-digit falls in many areas.
Why so many listings?
It's a combination. Record condo completions may be 40,000 to 50,000 units finishing up this year. Plus that market churn we talked about, NPRs leaving, people moving provinces, all adds up to more